Thank you all for coming. Lots of familiar faces here today. There are extra seats outside with a video in case you don't find a seat here. And if you could be so kind as to put your handheld devices on mute or silent, whatever the right word is, that'd be helpful. Good afternoon. My name is Michael Maybach. I'm a senior fellow at Aspen's 21st Century Manufacturing Program. Having spent 7 years at Caterpillar and 18 at Intel, I have a fond place in my heart for manufacturing, as well as respect for manufacturing. My first job at Caterpillar was a machine shop foreman, so if you see a disabled Caterpillar tractor along the road, it may be one that my line was involved with. They quickly got me out of the factory. Many commentators today speak of a post-industrial economy. They say that in this age of information, advanced economies like ours don't need manufacturing anymore. Indeed, some say we'd be better off not to manufacture at all and have a full-blown 21st century service economy here in the United States. Now, naturally, that makes those of us here at the Aspen Manufacturing Program feel a bit abandoned. But in reality, as it happens, manufacturing is all around us and is very cutting edge. The bicycle, car, or metro that brought you here, the elevator that brought you to the 7th floor, the chairs you're seated on, the cups in your hand, the lighting in the ceiling, this microphone, those video cameras, and all your handheld devices connected to towers, satellites, fiber optic cables, routers, and mainframes, all housed in buildings full of even more sophisticated gadgets, are part and parcel of any successful industrial economy. Indeed, we can't live without all that hardware connected to all that software. So if manufacturing still matters here in the world's largest economy, why is that so? Very briefly, 3 reasons I would suggest. Number one, any large, vibrant national economy like ours must have healthy, globally traded sectors, things we make and services we provide that are world-class and that customers anywhere in the world will choose over foreign or domestic competitors. Traded sectors are fully 1/3 of our economy. Intense global competition keeps those industries the best in the world, and manufacturing is America's largest globally traded sector even today. Domestic retailers like Walmart, Safeway, and Giant compete for your dollars, but they sell their groceries here. Ford and Daimler, Boeing and Airbus vigorously compete not just across the street, but all around the world. The question is, will they make those cars and those airplanes here? Number two, globally traded manufacturing industries are true engines of economic growth for 2 reasons. One, by definition, they must be globally competitive or they'd be out of business. And number two, they are at the heart of the wealth creation Adam Smith identified in specialization. Volkswagen, Ericsson, John Deere, Intel are all world-class manufacturers. When they invest in a U.S. manufacturing plant, they not only attract a myriad of services and retail businesses large and small, most importantly, they impart world-class skills and technologies to their U.S. employees and trusted suppliers. Technology, as we know, is transferred person to person, not email to email. Moreover, when one of those manufacturing firms comes to an American town, you can expect a Safeway or a Walmart to spring up in short order. The converse is not true. Finally, number 3, when you make something, you know about it deeply. You control it and its technologies. Interestingly, you are also continuously improving a product when you're making it. An underappreciated fact is that companies' R&D manufacturing groups have a 2-way relationship. There's a lot of learning and improving that goes on in the making of something. And so with these 3 thoughts in mind, I'd like to now introduce our executive director, Tom Duesterberg, who will introduce our group. Thank you.
Mike, thanks to all of you for turning out on this bright spring afternoon. I think it actually is spring. First, I want to I'm going to give an overview of the paper which we're releasing today on what we call manufacturing resurgence. I want to thank the sponsors of this project, Bison Gear and Engineering, represented today on our panel by its founder and CEO, Ron Bullock, and the Dover Corporation. I also want to thank the University of Maryland's Inforum Research organization, which ran the simulations that we used for this project and helped us interpret the results. Dr. Jeff Whirling and Dr. Douglas Mead are here with us today and will be helpful in responding to questions. The program for today is I'll give a brief overview of the findings of this study. Then we'll have a panel discussion with Ron and Jay Timmons and Steve Gold, the head of the Manufacturers Alliance. We'll talk amongst ourselves and we'll open it to the audience, as we like to do here at the Aspen Institute. So our goal in this project was to take a realistic look at a plausible resurgence scenario, which everyone is talking about, but which no one has actually modeled, to take a look, see what it would actually look like, what the economy would look like in terms of structure, how the microeconomy would change, and what policies could help us achieve this goal. Our starting target was to return to the level of manufacturing production as a percentage of the GDP, which is 15% before the three great recessions, the dot-com, the 9/11 recession, and the Great Recession in the last 12 or 14 years. This was 6 million manufacturing jobs ago. So we wanted to take manufacturing back up above 15%. We were at about 11.5 this year. LIFT model from Inforum. It's a well-tested input-output model widely used for longer-term projections. It is sensitive to feedback effects and features an extensive database and model for the industrial sector. We wanted to see not only could we get to 15% or more, but without undue systemic pressures such as inflation, labor and material shortages, insufficient capital inputs, or disruption to other large sectors of the economy. So we modeled two different scenarios, a business as usual or baseline scenario and a manufacturing resurgence scenario. In the charts that I'm going to show you, we refer to these as the BL, the baseline, or the MR, the manufacturing resurgence. In our baseline, the trend of slight decline as a percentage of GDP continues. We get down to 11.1%. In the baseline, we take it up to 15.8 in our more optimistic scenario. Our resurgence projection studied 4 likely sources for boosting domestic U.S. manufacturing. First, an increase in the growth rate for exports and a concomitant decrease in the growth of imports, that is, recapturing market share both globally and domestically. Second, reducing the rate of price increases for energy, especially for natural gas, which in itself depends on increased rate of growth in the supply of gas. Third, reducing intermediate input costs through a variety of factors, a reduction in the growth of the regulatory burden, some lower tax burdens on capital-intensive manufacturers, continued productivity growth, and reduction of duplicative standards for global products. And this is not an exhaustive list. Finally, increasing productivity in large services sectors, especially healthcare and wholesale and retail trade. Such an increase would free up labor, capital, and intangible resources such as intellectual property rights, which can be shifted to manufacturing to power growth there. Let me take you through a series of slides. Can you go to the first slide? One second. There we go. Okay, the first slide summarizes the demand side of our simulation. Again, our tables show both the BL and the first is the baseline, the second is the manufacturing renaissance in all of these charts. Total real GDP grows by 5.6% more in our resurgence scenario by 2025. Average annual growth of the economy is 0.4%, which doesn't sound like much, but over $30 trillion economy in 2025, it's quite meaningful. Fixed capital formation is also 0.5% higher than in the baseline on an annual basis. Total exports, both goods and services, grow at 6.5% annual rates, while imports grow at a slower level of 2.7%. Import growth is 1% slower in our manufacturing resurgence than in the baseline, and export growth is about 1.4% faster. Notably, real personal income is 1.5% higher in the resurgence. Could we have the next slide? Personal consumption expenditures are 3.2% lower in the manufacturing resurgence scenario as resources are shifted into investment and production for export from domestic consumption. Our next slide shows the supply side macro results. Real manufacturing value added in our scenario grows by $1.54 trillion in 2025 over what it would have been in the baseline. This represents growth of about 3.1% higher on an annual basis than in the baseline. Total value added is 49% higher in the optimistic scenario, but total output is only 34% higher. This is a result largely of lower growth in inputs at only 27% over the 12-year period, and some minimal increase in the pricing power for manufacturing goods, which are up a small 0.2% above the baseline. Could we have the next slide, Simone? Thanks. The third slide shows some of the macroeconomic impacts. Total employment in the overall economy by 2025 is 500,000 higher, but direct manufacturing employment, again, direct manufacturing employment in the sector is 3.7 million higher, and these jobs are on average higher paying than jobs in other parts of the economy. So personal income is 1.5% higher, or roughly $250 billion at an annual rate by 2025. Notably, the current account goes from a deficit of over $570 billion to a surplus of about $300 billion by 2025. Could we have the next slide? The next slide is going to show the share of GDP in terms of value added according to our simulation. Wow. Did I do something?
It's just been
Slow fading in. Okay, there we go. So manufacturing goes from where we are in 2012, we were at 11.6, goes to 15.8. The mining sector also increases, partly due to the revolution in gas production. Several services sectors decline in relative terms due to efficiency gains, or like healthcare, simply don't grow as fast as in the past or in the baseline scenario, so don't gain as a percent of GDP as they have been for the last 20 years or so, or even longer than that. Could we go to the next slide? So what accounts for this more optimistic scenario? Well, stronger export growth and slower import growth accounts for more than half of the gains that we see in our optimistic scenario. Manufacturing exports grow at an 8.1% annual rate, although this is only slightly higher, I would note, than the 7.8% growth that we have achieved since 2009. And I remind you that this is in a slow-growing world economy since 2009, especially in some of our larger trading partners. Imports continue to grow, but at a slower 2.5% annual rate. This is compared to, in the baseline, 4.2%, so just slightly slower than the business as usual scenario. So we reach a surplus in manufacturing goods trade of some, I must have hit that. Anyway, this chart is important. We reach a surplus in manufacturing trade and manufactured goods of about $200 billion by 2025. So more on why we think we can grow exports as much as this. First, stronger global growth than in recent years. Second, improving terms of trade for U.S. firms as labor, materials, energy, and logistics prices rise faster for our competitor nations than in the United States. The U.S. has superior performance and productivity growth as well relative to most, not all, most of our major trading competitors. Third, preference for U.S. production. Manufacturers are signaling a preference for U.S. production platform as executives factor intangible costs such as supply chain disruptions caused by natural disasters such as the Japanese tsunami and floods in Thailand. Also, a new appreciation for some of the political disruptions that has been seen in places like China and India, such as the loss of electricity or raw material inputs. This is one reason that many foreign firms, such as the German car makers, the Korean car makers, are locating more of their production in the United States and exporting from the U.S. Let's see. Let's go to the next slide. Okay, a final reason is that penultimate reason is we think currency values, the dollar will slightly weaken over the next 12 years by about 15% from where it is now. We have some historical data in our projection here. Reasons for this is foreign central bankers are starting to diversify their reserve holdings. Economic forces are working to correct existing imbalances, as Herb Stein once said, something that can't go on forever won't, and the U.S. trade deficit is one of those things that won't. And finally, the safe haven element for the dollar as a current reserve holding should wane as hopefully the global economy stabilizes. Our last reason is we think that the free trade agreements now underway, negotiations with both Asia and the TPP and with Europe and the US-EU partnership will be very helpful in opening markets further to US products. A second major reason for the higher growth scenario is reduced input costs. We assume reduced costs, burden of regulation. I'll talk about a little bit about that later. Some tax relief, although not a lot, to make U.S. firms competitive with average OECD corporate tax rates. Some regulatory efficiency from new comprehensive trade agreements where you only have to make one product, hopefully, that can be approved in foreign markets as well. The US-EU agreement is especially promising in that regard. Let's go to the next slide. So the third driver is increased natural gas production, which helps to restrain price increases for gas. And we do project that gas prices will go up slightly by about 3%. Production goes up about 3% per year compared to 1.3% in our baseline scenario. This compares with gas output growth of 4% the last few years, but I would note that that's the start of the revolution in gas production, which has waned as prices have weakened somewhat. So we don't think that 4% growth rate is realistic going forward. Prices in our scenario grow by 3.3% annually compared to about 5.8% in the baseline. Notably, also, we do not assume rapid growth in gas exports. We assume some, but not rapid growth. Although they do expand faster than overall production of natural gas. And Simone, could we go to the next slide? The fourth major driver is fixed capital investment grows slightly faster in our Resurgence scenario, about 0.5% faster than in the baseline. The capital stock of the U.S. economy, especially in manufacturing, has grown at historically low levels the last decade, and thus the stock is aging, so that additional investment is required not only for meeting new production, but to replace older plant and equipment. Personal consumption grows more slowly in our scenario, loses 3.2% as a percent of GDP And much of this share of GDP is shifting of resources into capital investment, which again is good for balancing the trade deficit. Finally, higher levels of investment result in greater capital intensity, and productivity is about 0.7% higher in our resurgence scenario by 2025 than in the baseline. Finally, labor force shifts slightly to manufacturing. Again, manufacturing has an aging labor workforce, so in order to fulfill our scenario with 3.7 million jobs, we need not only to fill the new jobs, but those who are retiring, which is there's a sort of a baby boom type bubble coming through in the manufacturing workforce that we're going to have to replace as well. We think that higher labor force participation, higher productivity in service-related sectors, and better training in STEM fields can foster this shift. Can we go to the next slide? Some of the cumulative, well, I guess I've skipped a few of these. The cumulative effect of the growth in manufacturing in our scenario, our resurgence scenario, can be seen in some of these projections of exports and imports. The cumulative impact facilitates the growth in exports and reduced import penetration that's shown in this slide. Some of the strongest growth in export is in energy-intensive sectors like chemicals, plastics, and metals, including fabricated metals. Total manufacturing exports grow at 8% or so. You get plastic and rubber above 10. Chemicals, apart from pharmaceuticals, 9.5. Some of the metals areas are all above 8. Electronic products as well. Other strong export growth is in capital goods, construction equipment, and electronics. Motor vehicle exports, I would note, which includes fast-growing exports from foreign nameplates in the U.S., such as BMW, Toyota, and Mercedes-Benz, grow much faster than imports, but we still show a large trade deficit in autos. And finally, we'll go to the last slide. This scenario can be, we think, facilitated and possibly accelerated with certain policy decisions that I'll just very, very briefly mention. On the trade side, complete FTAs such as the TPP and the US-EU partnership. I think we need to address competitive currency devaluation and currency manipulation. We suggest in the paper that there are mechanisms through the IMF and the WTO that ought to be explored if the G20 cannot address the question. Energy, we emphasize that we're on a very strong growth path. As long as we don't impede new production of natural gas, and as long as gas is produced in sustainable ways, this scenario should unfold as we project. More efficient processing of drilling permits on federal lands, which are 10 times longer than on state lands or privately owned lands, could also be helpful. We also think investments in the smart electricity grid would help the wind and solar electricity sectors. In terms of regulation, we emphasize avoiding duplicative and layered regulations, sunsetting regulation where possible. We also think, as I mentioned earlier, that some of the trade negotiations might assist in this regard if we can find ways to reduce duplicative international standards and harmonize where feasible standards in areas like autos and chemicals. In terms of stimulated a skilled workforce, I have a whole raft of things which I would draw your attention to in the paper that we suggest. Improve STEM education, attract non-traditional entrants to these fields, expand apprenticeship-type training partly with better industry educational institutional partnerships, and finally encourage foreign engineers and scientists to enter the U.S. workforce. In terms of tax policy, our formula is lower corporate tax rates to at least the OECD average, adopt a territorial tax, make R&E tax credits broader and permanent, take care not to harm small and medium enterprises through changes in corporate tax and personal income tax code, which affect pass-through entities as well as corporations. Finally, in terms of research and development and investments, we think it's important to maintain and expand federal investment in basic research in areas important to manufacturing, engineering, physical science, and mathematics. Doubling the budget for basic research, as the President recommends, would be a good goal. Also, rebalancing the allocation of federal research dollars to manufacturing-related fields, as these fields are being squeezed by healthcare-related R&D dollars in the last couple of decades. So, in conclusion, just say simply, we've laid out a scenario for substantial growth in manufacturing, which we think does not rely on radical change in direction or in policy. Policy change can help in making this growth scenario a reality, but the trends are already in place to set us on a stronger growth path. So that's the overview of the paper. I'm going to invite Jay and Ron and Steve to the stage. We will talk amongst ourselves, and if I could ask you to hold your questions till a little bit later when we've had our discussion. So thanks very much. Thanks. Ron, why don't you sit here?
Okay. Thank you, Tom. And welcome. What we're going to do is I'm going to introduce two good friends of mine, Jay Timmons and Ron Bullock, to provide some remarks to the study that MAPI and the Aspen Institute have just released. I'll ask them a few questions, hopefully not too hard, and then we'll open it up to the floor for questions. So let me first go ahead and introduce, and then as Tom mentioned at the start, technical questions about the model and the forecast. We're fortunate to have our friends Jeff and Doug from Inforum to provide answers there. So let me start with Jay, and I'm going to introduce Jay, the President and CEO of the National Association of Manufacturers since January of 2011. You were EVP before at NAM and Senior Vice President for Public Policy and Government Relations starting in 2005 at NAM. And then you also spent about a dozen years as the Chief of Staff to Congressman, then Governor, then Senator George Allen, and also Executive Director of the National Republican Senatorial Committee. So let me go ahead and turn it over to you and for your initial remarks.
Sure. Well, thank you very much, Stephen, and appreciate the opportunity to be here. Earlier this month, the NAM released our growth agenda, 4 goals for manufacturing resurgence in America. So we're very pleased to see this report because it validates what we've been advocating for many years at the NAM. Our agenda outlines the policies that we believe will strengthen manufacturing in the United States. It focuses on investment, it focuses on innovation, it focuses on trade, and it also focuses on the workforce of the 21st century. And we believe that with the right pro-growth policies in place, we will achieve a manufacturing resurgence and, in fact, an economic resurgence in the United States. But I think the real question that has to be answered is why should manufacturing lead the way? And here's what we know. We know that manufacturing has the highest multiplier effect of any sector of the economy. About $1.48 of economic activity is generated for every dollar that's invested in manufacturing. We know that manufacturers in the United States are the most productive in the world, leading to higher wages and better living standards. And we know that manufacturers drive more innovation than any other economic sector, performing 2/3 of all private sector research and development in the nation. So those are the facts about modern manufacturing, and we know that intuitively that growth in manufacturing will lead to a stronger economy and to more jobs as well. Unfortunately, we didn't have the data to support what we knew to be true, but all that's changed now. The report that's being unveiled today provides a glimpse of what a manufacturing resurgence would look like in America, and frankly, the results are astounding. Millions more jobs, a larger economy, more exports, just to name a few of the benefits. Importantly, this report demonstrates the consequences of staying on our current path. It shows what will happen if policymakers fail to enact pro-growth economic policies. If we stay on our current path, where it's 20% more expensive to manufacture in the United States, and that's after you take out the cost of labor, according to another great report by Maypai and the Manufacturing Institute, manufacturers' share of the economy will actually shrink by the year 2025. Job growth will be disappointing, with just 700,000 manufacturing jobs created in little more than just a decade. But with the right policies in place in Washington, those policies can transform our economy. 3.7 million new manufacturing jobs in a manufacturing sector that grows to almost 16% of GDP. So I think the lesson from this report is clear, and I want to thank Stephen and Tom and Maypai and the Aspen Institute for their great work in producing it. The United States needs a pro-growth agenda, like the one that the NAM recently unveiled, and in fact, we really can't afford to delay that. Policymakers just simply need to adopt the policies that we at the NAM have advocated in our growth agenda, and we'll continue to do just that until our elected leaders get the message and take the appropriate actions. So with the right policies in place, the manufacturing resurgence envisioned in this study won't just be a thought experiment. It will actually be a reality. So thank you, Stephen.
Thank you, Jay. And now Ron Bullock, an aerospace engineer, the chairman of Bison Gear and Engineering Corporation, one of the underwriters of the study. Thank you very much. You joined Bison in 1981. You were promoted to GM very quickly. You and your father partnered to buy the company in 1987, and the rest is history. What are your thoughts on this study?
Well, I bring the perspective of our small and mid-sized manufactured members in NAM. Bison manufactures electric motors and gear motors and controls that are used in a wide variety of original equipment applications. We have about 15% of our associates with engineering diplomas, 270 employees. We have a union, works out just fine for us. And we just recently, our people took pride in reshoring some AC input motors from Asian-based production. I'm going to bring a kind of a unique historical perspective as my grandkids look at me as older than dirt. I guess I am, but I was born 10 and a half months after Pearl Harbor, and Dwight David Eisenhower signed my Eagle Scout certificate. So I guess I've got, a historical perspective here. My family was in construction. I learned a lot about sweat equity and the dignity of work, from them, and they benefited greatly from a very good public school education in a great manufacturing town, Dayton, Ohio. As a country, we'd had our Sputnik moment, and I wound up graduating with 4 years of math and science and some courses in machine shop and drafting. And coming out of high school, I could make a living, and that provided me a lot of flexibility as far as paying for my education, getting married, and pursuing a career in advanced manufacturing. So, in Dayton, manufacturing were the most sought after and prestigious jobs in town, and I would contend they still are. It's just we don't have enough of them right now. So, what we've done here in looking at the at this report are generating some policy discussions on key areas that can help provide a manufacturing renaissance, and make it more attractive to earn a return on investment right here in the United States, as opposed to more attractive situations outside. So, we can provide during the time period, acquired the company in 1987 in a leveraged buyout. My dad came in as a co-investor, and he always used to try to inspire me by telling me that he's going to run out of money and breath at the same time, so I better work real hard. And I said, once he became a partner of mine, I said, not on my shift, Dad. So at any rate, we had the, there was, President Reagan, Speaker Tip O'Neill, and Senator Bill Bradley got together and in a bipartisan move, simplified the tax code. Our tax code is way too complex right now, and we could, stand doing that again. At that time, the top personal rate was lowered to 28%. So I'm, mathematician, qualified engineer, and I figured, if I switch from a C Corp to an S Corporation, that gave me an additional 7 cents out of every profit dollar to reinvest back into the company. So, that was very helpful in achieving, compounded growth rates of 15% for the next decade, to invest, in product tooling and equipment, and add a couple of hundred good-paying jobs to our payrolls. However, in the interim, we've more than erased those tax incentives. We have not been aggressive in negotiating trade agreements. We've seen regulatory burdens increase. I'm very concerned about the effect on our economy of the coming Patient Affordable Care Act, the Health Care Act that's going in. They just announced another 1,000 pages of regulations, and for a small company that's self-insured, it's, and even our larger partners at a meeting I was at last month, larger companies are having their own difficulties in trying to navigate this. So the regulatory burdens have been substantial. We don't, we have some good upside, as we pointed out, on energy costs, and we need to do no harm going forward. I've been really involved, with what I consider our most challenging issue in human capital development. We're not producing enough people with the right skill sets to staff, our needs in advanced manufacturing. We run a jobs board at the National Association of Manufacturers. During this whole economic malaise, it's never dropped below 600,000 unfilled positions. And now I chair the Manufacturing Institute. We've really been looking at what we can do to create a more robust education pipeline. And not everybody needs a 4-year college degree, but everybody in our companies needs some level of post-secondary education. So we have a certified, NAM endorsed certified skills system that has a lot of upside potential. Responding to President Obama's challenge to accelerate this. We have a goal of adding 500,000 skilled certifications in the next, by 2015. We're 2 years into the program and with 188,000, so well on board for that target. We've got the wave of boomer retirements coming. I go around the country and I feel like Paul Revere. The boomers are retiring. The boomers are retiring. At our own company, fully 55% of our own associates are eligible for retirement over the next 15 years. And I think, during the time period of this study, I feel that at least, we're going to have to provide a pipeline for 4 million. And then, add on top of that the 3.7 million we need to, fill the pipeline to grow manufacturing. That is going to be a real challenge for us. But, I'm glad we've got the report. It gives us, a basis for dialogue, and I'm very enthusiastic about our potential to turn around, a decline in manufacturing and get it growing again.
Thank you, Ron. So, Tom, I think, as you know, you shared with me information. Goldman Sachs chief economist Jan Hatzius has come out with some research. He said he doesn't see a manufacturing resurgence at this time. He says the 2009 bounce back is purely cyclical, that the natural gas boom is not going to give us enough of a competitive advantage in manufacturing to actually create a resurgence, a renaissance. What are your thoughts in terms of the prospects for a true revival in this country?
Well, in trying to respond to the Goldman study, he cited two things, negative things. One, the growth in exports was not that strong, and I would just note, we've made our argument in the paper, but the global economy has been relatively weak the last 3 or 4 years. So the fact that we've gotten a growth rate of nearly 8% in manufactured goods is reasonably good, in my view. Second, he noted that he didn't see any increase in particularly the energy-intensive industries that we think are going to be highly benefited by, especially the natural gas boom. I don't know what his time frame is, but you can go to the ACC website and pull down a list of new projects in the energy-related industries, and I just give a summary. In addition to a bunch of new refineries and refinery expansion projects, including some mammoth gas to liquids projects, which are probably $10 to $12 billion projects, these all take time. You can't build them in a year or two. It takes 5 or 6 years to build them. But iron and steel, there are 15 projects for either expansion or new plants, 4 new steel plants in the United States. Maybe all of these won't get built, but that's a good start. Michelin is building a new tire plant in South Carolina. In terms of plastic products, you can see 100 new projects. In terms of chemical companies, 65 new projects. So this takes time. As long as we maintain the trajectory we're on, if the global economy continues to expand and expands a little bit faster, a lot of these projects are going to come online, and I think that's when you really start seeing it in the numbers.
Jay, the study, a great deal of the resurgence that would occur compared to the baseline, it comes from us recapturing lost market share, increasing exports, reducing imports. I know that there's been bipartisan support for 2 different major trade agreements, the Asian, the Trans-Pacific, and as well as the European. What are the prospects? What's NAM doing? What is the business community doing to push for those?
Yeah, I think those 2 agreements are very important. Let me pivot, if I can, back to Tom's
Sure.
point and the question you asked Tom, because I think it's very important to remember that when we're looking at your report, which I think is very aspirational and it's definitely something we should be focused on, what I think gets lost in a lot of the discussion when new numbers come out, we do see some slight uptick in manufacturing employment, we see a slight uptick in output. What gets lost is this very heavy burden that is on the backs of manufacturers, which MAPI has helped us define 3 or 4 times, I think, in the last 10 years, and that's the cost of doing business in the United States. And so I think it's very important that we recognize that it is 20% more expensive to manufacture in the United States than anywhere else in the world among our major trading partners after you take out the cost of labor, taxes, regulation, energy, although this time we saw a slight advantage on the energy front. So I think to Tom's point, when we're talking about, and the point of the study, as we have more options for domestic energy supply, I think you will see more manufacturing come back into the United States, or more investments, I think more appropriately probably is more investments being made here in this country. But if we don't deal with that 20% cost differential, we won't see this resurgence. I mean, it's that simple. The tax burden in the United States, as we know now on the corporate side, is the highest in the world. That is not an incentive to invest in this country. So I'm really pleased that this report shows us what the path can look like if we do things right. And one of the ways that we achieve that path is opening up new markets for the United States. To your question to me, that is the 3rd goal of our growth agenda, and that is to expand markets, to expand manufacturers' access to markets around the world, to reach those 95% of consumers who live outside of the borders of the United States. Trans-Pacific Partnership has a it has a few kinks to work out, quite frankly, but it has very broad bipartisan support. I commend the president for talking about this European Union agreement that we hopefully will see negotiated in the near future. I also give him a lot of credit for moving Panama and South Korea and Colombia. Now, those three agreements really only added about a $16 billion potential for our economy, but it's something. We're making efforts and moving forward. I really don't think we can stop with TPP or an EU agreement. I think we have to really be aggressive. And if I was going to say that the administration could improve in one area, I would say that they need to be more aggressive in looking for other opportunities. But I'm pleased that we're focused on these, and I think manufacturers are very pleased that these markets are opening up, potentially opening up.
Listen, one of the most significant aspects, Tom, of this report, I think, is the fairly sharp contrast it draws between a U.S. economy with a vibrant manufacturing base and one without one. In essence, the difference between the baseline, which is business as usual, as you describe it in the report, and a manufacturing resurgence. Let's talk about the baseline for a second, because we didn't focus on it as much during the report. It has us contracting by 2025 to 11% of the economy. There's kind of anemic employment growth. Do you see this perhaps as a tipping point if it's just business as usual over the next decade in terms of the critical mass, or losing a critical mass of manufacturing here?
Well, it could be. A number of analysts have made the argument that if we don't sustain and try to nurture clusters of expertise, including regional or local clusters, we gradually lose both the physical and the intellectual infrastructure for manufacturing. And in this day and age, it's really advanced manufacturing that is driving the U.S. sector. I mean, there are always going to be sort of commodity-based industries, lots of them in consumer goods, that they're going to stay here. But it's these advanced industries that if we don't continue to support the technological edge and the production capability, our innovative capacity will generally wane. So we do need to keep at this. I don't know if I would call it a tipping point, but we certainly need to pay attention to it. Willie Shih and Gary Pisano up at Harvard have been harping on this theme for quite some time, and it's well worth looking at their perspective on it, because they reflect this thought.
Thank you. Let's go ahead and open up questions to the audience. Let's start with Jerry.
We have a microphone coming around.
And start with Jerry.
Well, let me just go ahead and start. Congratulations, Tom, on a very fine path-breaking study that I think sets out a framework about exactly what you have to do in order to get 4 more percentage points of GDP tied up with manufacturing. I think it's path-breaking. I think it is aspirational. I think the Goldman Sachs thing, in addition to the point Jay makes, is wrong because it just looks at the current cyclical baseline data. And of course, if you project off of that, you don't get anything but what that is. So it's really not very relevant in terms of a critique of what you've done. But in order to strengthen what you've done, let me ask this question. If you look at the actual numbers that you talked about, it was very clear that 50% of this comes from the export-import side in terms of gains. That's very powerful. I've not heard that before, which makes both the trade export enhancement and tougher trade policies kind of more important than anything else to advancing that GDP gain. When you go beyond that, the numbers become a little less clear, and I just wanted you to tell me more about what the model supports in terms of policy. How much more do you get from the natural gas gains? Is it 10%? Is it 15%? And then if you look at taxes and you look at the other basic research and items that you have, can you put numbers in a priority sense on any of the other policy areas like you did with respect to net exports?
Well, I may ask Jeff Whirling to chime in on this as well, but you're right. The trade, improving the trade performance is very important, including recapturing domestic market share, capturing some of the growth. A lot of these other factors that we mentioned, tax, lowering intermediate costs of one sort or another, higher productivity in the services sector, the regulatory side, all feed into more competitiveness, as you well know, for our export sector. In terms of raw numbers, I'm going to defer to Jeff, but it's something it's hard to disaggregate, I think, and I think some of the other factors are probably 10% or less of the total impact. But Jeff, do you want to elaborate on that?
Yeah, as far as decomposing the effects in kind of a linear way, it's very difficult to do because in this following sense. The biggest assumption that you make in driving the trade is that the rest of the world starts growing a lot faster, and doing that in the context of a rebalancing world economy. So people have, for 10 years, 15 years, have talked about the rebalancing, for example, China becoming more domestic demand driven, the U.S. becoming less domestic demand driven. I think that's a big assumption behind the numbers that we put. So you have to have a healthy world economy for this to happen. And the other big factor in allowing manufacturing to grow in the United States is higher productivity growth in the non-manufacturing sector. So this is something that I think gets a lot less thought about. But when we talk about healthcare, and healthcare is the most important aspect here, is we're all for kind of preserving the demand for healthcare going forward because we think the consumers obviously want that and need that. But we don't focus much on increasing labor productivity in healthcare, which is really the key here, because manufacturing will have a difficult time to grow. And the final thought of that is, again, we're trying to rebalance the U.S. to a more investment and manufacturing and export-centric economy as opposed to a consumption economy, because ultimately we have to do that because our debt, not the federal debt, but the debt of the country to the rest of the world is rising every year. We have a current account deficit, and eventually that has to stop. Now, the hard way is a massive depreciation of the dollar. The easy way is just becoming more balanced in this fashion. So as far as attributing each one, economics is rarely compartmentalized and linear, but this is a big circular thing. So.
Richard.
Hi, Richard McCormack. I'm editor of Manufacturing and Technology News. I've been an unfortunate reporter who's had to chronicle the decline of these industries for the last, especially 10 years. And I've heard this argument.
You've done your job very well, Richard.
Thank you. And I've done, but I've heard this argument really for a long time. And if we're at a tipping point, what's going to change our policymakers to get them motivated to do something, as you've described here, to change this trajectory?
Well, I'll take the first stab at it. I've tried to make the argument elsewhere that as you look ahead for the U.S. economy, what are going to be the drivers of growth? We had, for instance, in the 1990s, we had technology, and we had a technology bust. We had housing in the first decade of this millennium, and we had a housing bust. Each of those was driven a bit by debt financing. Financial sector was a source of strength. So we had technology, finance, construction. As you look ahead, those industries aren't going to go away, but they're probably not going to be growing as fast as they did. I think most people will say, well, we got overheated, we learned our lesson, we're not going to devote as much of the economy to those sectors anymore. So where does that leave you? That leaves partly the manufacturing sector. And it is true that in recent years, we have seen a little bit of a change. I mean, we've actually grown, manufacturing has grown slightly as a share of GDP since the recovery began. I think we were at 11.1% at the low point. You know, we're up to 11.5, 11.6, so it's growing faster than the rest of the economy. But I think policymakers are out looking, you know, where is the growth going to come from? Where can we see good paying jobs? I mean, that's one of the mantras. And you know, the Commerce Department just recently put out another study showing that there's a 17% differential in wages and benefit for the average manufacturing job versus the rest of the economy. Concrete proof, the US-EU trade agreement, I know this administration thought long and hard about whether or not to go into that negotiation, and they wouldn't have gone into it if they didn't think they could get it done. That was one of the criteria they hammered away at the Europeans at before they entered into the agreement. So that's not indubitable proof that we are overcome the historical obstacles, but I think a few signs that people are taking a second look at manufacturing and probably will try to think hard about how to make it happen.
You know, Richard, since you and I started working together about 7.5 years ago, when we started working together about 7.5 years ago, nobody in Washington was talking about manufacturing. And since that time, there's been a radical shift in public opinion, in what policymakers and candidates are talking about. And we actually did some polling on Election Day and some exit polling, and it showed that 52% of voters took manufacturing into account when they cast their votes. Well, that doesn't mean that that's all they voted on. But if you'd have taken that same poll 7.5 years ago, I guarantee you it would have probably been about a quarter of that. One of the reasons for that change is this president has talked extensively about the need for a manufacturing resurgence, because he gets and understands, and his economists understand, the multiplier effect of every dollar that's invested in manufacturing, not only in terms of additional investment, but also in terms of jobs outside of the manufacturing sector. Others and in leadership in the House and the Senate are focusing on manufacturing. It doesn't mean they're getting the policies right. We all know that. But when you have data like this that shows what can be achievable, what happens to the economy if you really do focus on growing the manufacturing economy, you start to get some positive action. And we're seeing, you know, the first step is to get the awareness level up. And I think we're there. We can always get more, have policymakers be more aware. The next step then is translating that into good policy. And we're starting to see a lot of proposals in Congress, and actually a lot of things coming out of the administration that will strengthen manufacturing. I think we just have to keep that ball rolling a little bit more to get this going. But I do think it's achievable, and I think an aspirational study like this can help make the point to policymakers that what you're doing when you take a difficult vote, it really does matter. It matters for the future of the country. You know, I don't mean it to sound trite, but it's true. For your kids, for your grandkids, and the next generation of Americans.
Rob.
Hello, Tracy Dove.
Whoop. Okay. And can.
Hello, Dove from the Embassy of Switzerland. I just have a quick question about the manufacturing resurgence. How is manufacturing talking with the educators in the United States?
Great
And do you feel that the current discussion between educators and manufacturers is sufficient? And if it's not, how are you going to move into a manufacturing resurgence in the future? Thank you.
I think I can answer that. This is one of the primary focuses of the work that we're doing within the Manufacturing Institute, which is the 501c3 for the manufacturers.
And for those who didn't catch it, Ron is the chairman of the institute.
Right. So, I also chair the a similar type of initiative on a statewide basis. So, what we're doing is really kind of a grassroots issue that is taking hold because we're talking about career pathways, And I finally made it to Harvard last week. This is even being addressed at the Harvard School of Education in Cambridge, where we're really getting serious about, and also with the Common Core standards, there's an equal emphasis on career along with college readiness, as when we address our K-12 system. So it's one of these deals where you think globally, act locally. And so we're pairing up, within the program that we have within the Institute. We're in 35 states working with local school districts, community colleges, and universities. And you start getting some very powerful numbers. It works. I can attest to, the success we're having in Illinois. So, when you're getting a good dialogue going with, teachers, parents, on a local level, and I think that will tend to bring up the these issues so that we get better emphasis on skills that people can make a good living with in manufacturing.
It is a very decentralized effort. I note that the CEO of Siemens Industry, Helmut Ludwig, is here. Siemens is very involved at the community college level. We have other manufacturers involved with other community colleges around the country at the regional level. So it's very decentralized, but manufacturers are taking upon themselves. And Jay, you were going to probably add to that. This is something we're seeing a lot of our member companies getting involved in the K through 12 and at the community college level.
Every single one of my members actually identifies the skills gap as and the coming workforce crisis as a top issue for them to deal with. I think the average age we just had a board meeting in March, and I think we found the average age of the workforce for our member companies is around 52 years old. So if you think about the fact that we have a 600,000 person skills gap right now, and think about what that could be in 10 to 15 years, I mean, you realize you really do have a problem. And I don't want to really brag on Ron's work with the Institute. It's not only the skill certification program where the Institute has set a goal of 500,000 portable skill certificates, certifications by the year 2016. It's also a program that they've instituted on matching returning military personnel with manufacturers who need the skills that a lot of these folks coming back from their military duty have, but don't understand how to translate into manufacturing. It's also the work that they're doing on recruiting women into manufacturing because, I mean, let's face it, manufacturing has not been identified as a key area for women to go into, and we're seeing more and more women enter the manufacturing workforce. It's the Institute and the NAM's work on immigration reform, comprehensive immigration reform, that includes a pathway to citizenship. We have 13 million folks out there, and a lot of them have the skills that we would love to be able to use in manufacturing. And then one last thing that I think is really crucial to your question, and that is getting young people excited about a career in manufacturing. When Jerry Jasnowski headed the Manufacturing Institute and the NAM before that, he created a program called Dream It, Do It, which is a great way to introduce young people to manufacturing of today. Manufacturing isn't our grandfather's manufacturing anymore. It's sleek, it's technology driven, it's cool. I mean, it's got a wow factor for young people. And Dream It, Do It has been really successful in getting young people interested. I call it kind of a hybrid between, and Jerry, you can correct me on this, but a hybrid between kind of the old-fashioned shop class that I had when I was a kid and junior achievement. It really gets young people inspired about what a career in manufacturing can mean for them. And a great example of how it really is working is in the state of Nevada, where the governor and the first lady have taken on Dream It, Do It as kind of their cause célèbre, if you will, and they're getting it into high schools all over the state so they can get their young people interested in a career in manufacturing. It's a tough road to hoe, there's no question about that, but with these efforts in state after state after state, community after community after community, we can overcome the skills gap.
Hi, I'm Rob Scott of the Economic Policy Institute, and I'm going to push a bit on the currency issue. I think it's central to as a driver for where we're going to get the demand for these new manufactured products and manufacturing jobs. I've done a study that says we can create 2 to 5 million jobs in the next 2 or 3 years by getting the dollar down to a more sustainable level, ending currency manipulation. Bergston and Joe Gagnon have come up with almost identical numbers. I think, though, that the method of getting there is where we differ. You're talking about going through the WTO and the IMF, where you have to have almost 100% agreement. I think we're talking about methods where you could get a group of countries that say no to the currency manipulators, starting with the United States, but you don't have to have unanimous support for that effort. You take the big countries that are being hurt most, and we have tools available to do that now. I'd just like to get your reaction.
Good. Well, I'd like you to send me the report, because I think that's very interesting. I think currency manipulation is one of the great distorters in trade today. It is an issue that I think is absolutely critical for us to address as a nation. I would like to see more action from the executive, not only this executive, but his predecessor. We do have this balance of, how do you take action and not incite some sort of a trade war, and I don't think anybody wants to see that. So please send me your study. I'd like to see it.
I'll send you both.
Thank you.
Helmut Ludwig, Siemens Industry. First of all, congratulations to the study. I think it adds enormously to the discussion. You mentioned Pisano. I think we have now a lot of facts that add to their study here. The key question is, of course, what holds us back? What could be some of the risk of that this really becomes reality, what you describe here? We talked about the skills gap. Ron, you mentioned it. What are other elements that could hold us back that this is at risk to happen? And the other way around then, how do you make sure to overcome these risks that it really happens as you describe it?
Well, we tried to lay out as clearly as we could what we thought the sort of purely economic constraints might be, and I think those are perhaps secondary to the more political constraints. But to try to respond to your question, I think global growth is still something that we can't assume, at least rapid global growth like we enjoyed in the 80s and 90s and part of the decade of the 2000s, at least part. We do have to get macroeconomic, global macroeconomic conditions in a more stable path. There are all kinds of threats out there. The European banking situation is not fully resolved yet. There's a housing bubble in China. Currency wars, getting into the political, seem to be heating up a little bit. These are all questions that I think can be addressed by level-headed policymakers, but it's not 100% sure that we'll be successful in resolving them. Domestically, I agree with Jay that we do need to address the production of human capital more carefully. We need to think more about that and think through, if we're going to have a really strong manufacturing sector, exactly what the skills are that we need there, what the research skills as well as the factory floor skills are. Continuing to work, what the manufacturers have to do is continue to work to keep their costs under control. There's been a good productivity story in the United States for a couple of decades. There's no guarantee that that can continue. We do need to make an investment in national research, basic research. What companies like Siemens or General Motors or Bell Labs might have done 30 years ago. Global competitiveness has reduced the margin to be able to invest in cutting-edge research, so we have to look to our excellent national university system and support of that system and federal funding for research dollars. All those things are questions. I think my own view is they're not insurmountable obstacles, but we do need to address them.
Let me just add one thing to that, and this ties into Richard's question, and that's simply political stalemate in Washington is also obviously an obstacle. We do a quarterly business outlook with our top financial executives, and uncertainty in the policy and the political arena are keeping manufacturers on the sidelines in terms of investments. So obviously, I think in terms of policy, it starts with simply jump-starting the folks in Washington. So, yes.
Hi, my name is Nagesh and I'd like to thank you all for this. This is a great report, and I'm a big fan of Make It in America. I think we need that, absolutely. And definitely from the West Coast, we'll say that we're doing that a lot in the maker community with Tech Shop and the shared platforms. So I just kind of curious about the metrics. So about shared makerspace platforms, especially with the public-private partnerships, and also because you definitely tout in the policy report about that intersection between university and industry. So university doing a little bit more of the research R&D, and then industry commercializing that. But I think one thing we want to talk a little bit more about then is the intellectual property ownership and how that can be the efficacy patterns around that to make it much more efficient, but also just getting America back in the game and be number one. Absolutely.
Do you? Go ahead. As you know, being from the Silicon Valley community, the concepts of intellectual property rights are changing all the time. Layered on top of that is that a lot of the intellectual property is being developed in the university setting now, a lot of times with federal research or private research. But also the model is changing. The speed of change is much faster than it used to be. So our traditional concepts of patenting, how long patents are held, copyrights, what is copyrightable, what is patentable. These are questions that I know are important, but I'm not sure I have the answer. I'm a firm believer in the evolution of the economy, evolution sort of organically, if you will, of new concepts to address the changing reality, then hopefully the policymakers can see what's really working in the real world and adapt the legal structure to follow that. But I don't have any real prescriptions myself to offer.
And that's why I let Tom answer the question.
Just from the process, from an innovation standpoint, manufacturers are very good at commercializing technology. My favorite definition of innovation is that magical thing that happens at the intersection of invention and commercialization. But we could do one of the tax issues we haven't talked about is the research and development tax credit. And it's very important for manufacturers to be able to continually develop new products so they can make better margins, and have more capital to reinvest back into their businesses. Right now, I can look across, north of the border in Canada, and I would get a minimum of 20 cents on the first research and development dollar, and that would repeat every year. Our formula right now in the United States is it's kind of complicated, but it's the differential between the average that you've spent over the past 3 years and what you spend this year. So let's say you spent increase your your development activities by 20% from 1 million to 1,200,000. Our credit here would be 20% of the $200,000. In Canada, it'd be 20% of the $1,200,000. So there's that's a nice incentive going forward. The other thing is that it's like year to year, and are we even going to have the R&D tax credit the following year? So we need to get more serious about rewarding the risks that you are taking when you engage in true innovation.
This gentleman back here. Yes.
Yes. Okay. My name is Nan Kiritith. I'm from teaching at SAIS, Johns Hopkins University. I just want to say thank you for the comprehensive analysis of manufacturing sector. But I'd like to ask a question. There seem to be certain assumption behind this forecasting. One is a forecasting assumption on the technological side, which I can subsume by subtitle by tech productivity, and the other side is financing, which I like to know. Do you assume there was sufficient financing or not sufficient financing? And I like to suggest that there is a recent analysis by the Federal Reserve of this country regarding the integrated analysis of the real sector and the financial sector. And in that analysis, it has shown that it has a quantum shift from the real sector of saving from the real sector to the financial sector. And that was the cause of the financial crisis in 2007.
Well, I'll take a stab at that, Kiri. In terms of the availability of financing, we tried to make the point that we would, through productivity gains in other parts of the other sectors of the economy, we could free up some resources. We do reduce consumption expenditures, so personal savings rate actually goes up just a little bit. So those are two sort of macroeconomic areas you can look to. But what we didn't really mention was there's a lot of cash on the books of non-financial corporations right now. You know, a lot of that is held abroad, basically for tax reasons. But the most recent number I saw, and I can't corroborate it, is 1.9 trillion on the books of cash on the books of non-financial corporations. So to me, the problem is probably not financing. The problem is, secondarily, the ability to repatriate that capital in a way that's economically efficient, but also to reignite the animal spirits, if you will, have our business community have enough confidence that their investments will pay off in the long run. There's been so much instability in the last 10 or 12 years that both economic and political instability, that there's some doubts about that. So we have to reignite those animal spirits, if you will. But I think the financing is there.
Tom, I'd like to be precise a little bit on that. Financing surplus in corporation, you mean which corporation? Financial corporation or non-financial corporation? Or small and medium business or big corporation?
Well, I don't have a background, but that number is non-financial corporations.
We're going to take one more question, and then the panelists will hang around a little to go ahead. I'm sorry, Susan, make you run all the way up here.
Thank you. Rich Miller from Bloomberg. I'm a little puzzled by what the report actually says, because you seem to take issue with the Goldman Sachs analysis and saying that we are on a sort of trend of resurgence. But then the report's baseline suggests that if these various assumptions don't come out, we won't have a trend of resurgence. So I guess I'm trying to puzzle. Are you saying that trends that are already in place are towards a resurgence of manufacturing, or not, basically?
No, I could show you the year by year if you wanted. It starts out slowly. It's partly because we're in a period of slow growth, and that's the cyclical, if you will. We're in a period of slow growth. And as I mentioned in answer to another question, a lot of the investment that has to take place is longer term. I mean, it just takes a while to build a petrochemical plant. It takes a while to build a new auto assembly facility, for that matter. So the trend line accelerates after a few years. I mean, my own view is that we do need to, I would like to see that trend accelerate, but that we are on a positive path right now. And I think the numbers show that. Manufacturing is growing at about twice the rate of the overall economy right now.
I understand on the baseline has it going down as a share.
Well, it's
even though we're on a positive path. It seems a contradiction, I guess.
Jeff, can you elaborate on that at all?
Well, the up to now, I mean, manufacturing has a large part facilitated growth because it becomes small, in the sense of the value added to GDP, because its productivity is so much higher than the rest of the economy. But let's go back to the idea of the perspective. I like aspirational is good, perspective is good as well. We don't know what this recovery is going to look like in the sense of the global environment and how the U.S. economy is going to react within that. So there could be two ways. There could be the business as usual, okay, which actually does, I think, have a little bit of a nice rebound for the U.S. in terms of exports and imports, but not enough to really move that size of the manufacturing economy. And also, it really has a very, very slow progress in reducing the current account deficit, which is in one sense the bottom line of all this, because eventually that has to shrink and even become positive. So that's the business as usual, and that could very well happen in the next 20 years. At the end point, we'll just be much bigger debtors. And I think the income will be a bit lower. Now the second one is, aspirational in the sense that, well, if certain things happen, and we touched on a few of them, and a policy environment that facilitates the surge in manufacturing, and we could see something, different. And that world has, more manufacturing jobs, less jobs and services, and also has, higher level of exports, and therefore a current account balance that looks more sustainable over time. So maybe the world will be somewhere in between. Anything that's a little better than that baseline is probably good in the long run, better in the long run.
Thank you very much for joining us today. And Tom, any final words?
No, thanks to all of you for coming out.
I just wanted to say that we really need to take the challenge. If we're willing to settle for 1.5 to 2% GDP growth over time, we're in big trouble. So we need to, as a country and policymakers here in Washington D.C., we need to take it upon ourselves to grow the economy, because I got 5 grandkids that I'm concerned about them. Thanks for coming.